If your goal is to truly become wealthy, and by wealthy, I mean not just driving around in a paid-off Toyota Corolla, I mean having the nice things that you want, having the vacations, having the lifestyle that you want, you're not going to achieve that by just getting a 3 to 5% raise every year or by maxing out your 401k. I'll show you. Wealthy people become wealthy not because of the income that they earn, but because of the assets that they own. Your assets are the investments that you own that pay you even when you don't go to work. That's why wealthy people aren't just working for a bigger salary, they want more assets. The reason why is because number one, like I just said, when you own the assets, you keep getting paid even when you're not working. And then second, the income that you earn from your salary is also taxed at a higher rate than the income that you get from your assets. This is why wealthy people want to own assets, because there's a limit to how much you can do, but there's no limit to how much you can own. Now, in this video, I'm going to be talking about 9 different assets that you can consider owning. That way you can really work to build your wealth, especially over the next decade. These 9 assets that I'm going to be going over are: number 1, investing in creative real estate; number 2, owning real estate rental properties; number 3, investing in dividend funds; number 4, growth funds; number 5, strategic savings; number 6, physical gold; number 7, startups; number 8, cryptocurrency; and number 9 is your education. So let me jump in and start by talking about number 1, which is creative real estate. I am a licensed real estate salesperson. I got my real estate salesperson's license back when I was in college. And when you are going to get your real estate salesperson's exam, and when you learn how to sell real estate, the thing that you're always told is that real estate, this home that you buy to live in, is your biggest investment ever. That's what we tell people. That's what people are told. And that's one of the biggest lies when it comes to actually spending money, because, well, your home is really not an investment. I mean, it's kind of an investment, but it's really a money pit until you ultimately sell it. And then when you sell it, you have to hope that your home is worth more than what you bought it for. And up until then, not only do you have to pay money for your mortgage, for your interest, for your property taxes, for your maintenance, for all the upgrades, for the furniture, and for everything else in between, but then you don't know what the home is going to be worth when you sell, and when you sell, you no longer have that home. Plus, not to mention, no wealthy person talks about how they became rich and wealthy because they paid off their home or because they bought a home that's worth a lot more money. That's not how it works. But your home that you live in can strategically become an asset if you look at being more of a house hacker. What does that mean? When you go out and you get a mortgage to buy a home, you're getting a mortgage for a primary residence. But what is a primary residence? See, in the United States, a primary residence can be a single family home, it could be a condo, it could be a duplex, it could be a triplex, or it could be a fourplex, a quadplex. Now, let's think about what that means. You can go out and get a mortgage to buy a 3,000 square foot home. But you could also get that mortgage to go out and buy a 4-unit apartment complex. It's really not called an apartment complex, but a 4-unit building. Now, if you can build or buy this 4-unit building, you can go out and get a regular mortgage to do that. Now, when you go out and get a mortgage to buy this 4-unit building, you just bought yourself a home. But you also bought 3 neighboring homes as well. And those 3 neighboring homes you can rent out to other people. Now, when you rent out these 3 neighboring homes to other people, these are your tenants. But they're also now going to be paying for your mortgage. And if you do this strategically now, you could have 0 mortgage payments coming out of your pocket, because now you went out and you bought this home, this 4-unit property, this 3-unit property, this 2-unit property that now has other tenants there that are working to pay rent, and this rent is being used to either subsidize your mortgage or completely pay for your mortgage. That way you have 0 to low housing costs. Now, what did you do? Well, yeah, you have a home to live in, but also you're subsidizing your housing costs, so you have less money going out for your housing costs. And then if you have to go out and sell this home, if you can sell this home for a profit, well, you get the same benefits to selling your primary home as a profit, because this is your primary home. Because now if you can sell this home for, say, $100,000 profit a couple of years down the road, with $100,000 can go in your pocket tax-free because it was your primary residence. Or if you don't go down that route, what you can also do is after 1 year of living in this property, you can move out 1 year and 1 day later and then start this process all over again. Because when you go out to get this primary residence loan, you can't go out and just rent that home to somebody else. It has to be a primary residence, meaning you have to live there. But the living there intention has to be just for 1 year long. So if you buy this home to live in, you bought this 3-plex, this 2-plex, this 4-plex house, you live there for 1 year and 1 day, then you move out and go to another property well, now you can start this process all over again, and then you can rent out the unit that you were just living in. So now this first home that you just bought becomes now a cash flow producing asset. You go out and buy another home, and you start this process all over again. And in a few years, now you can have a few properties that are producing cash flow for you. And if you are in a high demand area and home values go up, well, that also means that the value of your assets also go up too. So when people talk about, oh, I don't have the money to go out and invest in a rental property because I want to go out and buy a home for myself, well, you can use creative house hacking to go out and make the home that you live in an investment instead of just thinking that the home that you live in is an investment. And the reason why I like to say that the home that you live in is not an investment, because it's very easy to get people to buy much bigger and much more than they can afford when you think that the home that you live in is an investment, because everybody says the home that you live in is how you build generational wealth. You build this equity in this property, and now you have generational wealth that you can pass down. But if you really want to build the generational wealth, the best way to do that is not through just owning the home that you live in, is through owning assets that are going to pay you for owning them, even if you have to sell that property, because if you sell the home that you live in, well, you no longer have that asset. The second type of asset that you can buy if you want to work to build wealth and build real wealth over the next decade is by investing in rental properties. Now, we kind of already hinted at this when we talked about creative real estate, but let me talk about why wealthy people love investing in real estate. I didn't learn this until I started investing in real estate myself. But there are 3 reasons why wealthy people start investing in real estate. Number 1 is because you get the cash flow. Number 2 is because you own hard assets. And number 3 is because you get tax breaks. Now, I am a licensed attorney, who's not your attorney, but what I can tell you is that real estate has some of the biggest and best tax breaks that a tax code has to offer, period. What does that mean? So now if you go out and you buy a property, you buy a rental property that you want to rent out to somebody else, you buy an apartment complex, it doesn't matter. You are going to generate income, right? The tenant's going to pay you rent. You're going to pay your expenses out of this property, and then you're going to have some profit in your bank account, assuming you do it correctly. Now, the first thing is you can take some write-offs against this profit. What is a write-off? A write-off is an expense that you need for the business. So let's say you need a cell phone to run your rental property business. Well, that becomes a write-off. You can write that off against your profits. Let's say you need a car or a truck to get to and from your rental properties. That becomes a write-off. Now you can pay off or write off a piece of the value of your truck or your payments. If you have payments on your truck, don't recommend having payments, but if you have payments, you can write those off. You can write off a piece of your gas that you have to pay every 2 weeks on your truck. You can write that off as well. Your maintenance on the truck, those are things that you can write off. Maybe you have to have lunch meetings with brokers or other team members. Those can become write-offs. Maybe you have to go to Hawaii to look at some rental properties. That becomes a write-off. So now the question is, how can you strategically write things off? Because what wealthy people do is not ask the question of, is this a write-off? They ask the question, how can I make something a write-off? That's why you hear wealthy people talk about they don't pay any money in taxes. The reason why is because everything they do revolves around their business. And that means now they're always looking for ways to turn whatever they're doing, whether it's traveling, whether it's eating out, whether it's going on golf trips. They look for ways to turn these into business write-offs. That way they can now lower their tax liability and use the income from their business or their rental properties to pay for a piece of the lifestyle strategically. That way they can pay less money in taxes. Now, as a little piece of advice, if you are investing in rental properties, get a good accountant. That is the best advice that I can give you here, because the reality is if you start doing this the wrong way and you end up on the wrong side of the IRS, they are going to come and they're going to fine you, and they might even put you in jail. That's why you don't want to play around with the IRS. You want a professional here who can help you do this strategically. And another piece of advice when it comes to getting a good accountant, you do not want an accountant who only files your taxes. And I'm telling you this from experience here, because I've had good accountants and I've had bad accountants. The bad accountants that I had cost me less money month over month, right? The monthly fee for the accountant was less, but they ended up costing me way more money overall because I way overpaid in taxes, because these bad accountants, all they did was they looked at the reports from my business and my rental properties, and then they filed my taxes, and that was it. Now I pay way more money for my accounting fees for my good accountant. I mean, many multiples more money, but now I'm meeting with my accountants very regularly. If it's not quarterly, it's monthly. It just depends on how busy my schedule is, but at least quarterly, I'm meeting with my accountants. Why am I meeting with them? For tax planning and tax strategizing meetings. This is where the money is. If you are investing in rental properties, if you have a business, you need to have these types of tax planning and tax strategizing meetings, because this is where now the accountant, if they are an experienced and smart and good accountant, they're keeping up with what the tax code says. The tax code is over 2,000 pages long. I've read a lot of it in law school. The average person has no idea what's in this rule book. I can tell you that because I've tried to read it, and it is so boring and so detailed. But a good tax accountant, not only are they going to read what's going on there, but they're going to be keeping up with the new regulations that are happening, because constantly things are changing in the tax code. And that's where they want to be meeting with you and say, okay, here's how much money you made in the last quarter. Here's what your tax liability would look like. And here are the options of things that you can do based off of how the tax code is changing, or based off of my recommendations of things that you can do to potentially lower your tax liability. There's a lot of different things that can be done on the tax side, but you need a good advisor here. That way they can, number one, guide you and make sure you do not get in trouble, because there's a lot of rules here. The IRS rule book is a rule book, and the way that you win is by understanding the rules, and you don't want to be doing that yourself. You want to make sure you're playing within the guidelines, within the rules, but you need an advisor, a coach, somebody who can sit there and help you do that. So my number one piece of advice there to get the best tax breaks is to get a good tax advisor. The second thing is you own a hard asset. We are living in a time where we are still seeing high inflation, where the Federal Reserve Bank is worried about inflation, where the Federal Reserve Bank is working to raise interest rates to preserve the health of the dollar at a time where the economy is going through a lot of ups and downs. This is where people want to own things like hard assets. A hard asset is something that you can see, feel, and touch. When you invest in real estate, you can see the physical building. You own the bricks, you own the land, you own the windows. You have a physical asset, as opposed to something in the stock market where it's a paper asset, where you own a piece of paper which says you own a piece of a company. So when you own real estate, you own something real, something physical, something tangible. And the third benefit to investing in real estate is you get cash flow. When I go out and invest in real estate, my goal is to generate a 7% cash on cash return on my money. That means if I go out and I invest $100,000 to go out and buy a rental property, if $100,000 is going from my bank account to this property, I want a 7% cash on cash return, meaning $7,000 of cash flow profit after paying for my expenses this year at least, and next year and the year after that. Hopefully more in the following years, but at least that's 7%. So that means I get the rental income coming in from the property, and then I use the rental income to pay for the expenses. And then after paying for the expenses, I still want the 7% of profit in my account. Now, the cash flow is just the cash flow. If you're investing in a good area with growing demand, you should hopefully also see the value of your real estate go up as well, become more valuable. But for me, that's just icing on the cake. I really don't care what's going on with housing prices or real estate prices, because when I go out and I make my investment decisions, I'm making my investment decisions based off of one thing: cash flow, not future potential appreciation. That's speculating to me. That's gambling. I really don't try to predict where home prices are going. Instead, what I'm looking at is I'm calculating how much money this property is going to cost me after repairs, how much we can rent out this property for, because that is much easier to calculate. You can just look at the market data to see what the rental value is. Then you can put in a good estimate as to what your costs are going to be. Especially when you've been investing in real estate for a while, you're going to get a very good grasp of understanding what your monthly costs are going to be depending on the age of the property, the quality of the property, and then you just run the numbers. This is what you think you're going to get in rent. This is what you think your expenses are going to be. Add in a little bit of margin, because sometimes you can be wrong, and that is your leftover profit. If that leftover profit is enough to justify you making that investment, for me, that's at least a 7% return. That is a good deal for me. If it's not, you keep looking. Yes, today's housing market is still crazy. Yeah, we have a lot of downward pressure on the housing market with the interest rates rising. But again, I'm not sitting here trying to time the market. What I'm looking for is just the right returns, the right cash flow for me. The third asset that you can consider investing in are dividend funds. Dividends are when a company has a profit, a big profit at the end of the year. And now when they have this profit, they can do three things. They can either save this money for an emergency, they can take this money and reinvest it back into the company, or they can give this money away to their shareholders, to their investors, in the form of a cash payment. Now, if you are a startup or a growth company, you're not going to necessarily want to save a lot of money, because you're going to be investing as much of this money back into the company. That's why you hear a lot of startups don't have any profit, because they're reinvesting all the money that they're making. So companies then who are much older, a little bit more mature, that have those big profits, that no longer have that same need to invest back into the company. They are going to have the ability to then just give it away to their shareholders. That is a dividend. You get dividends, which is cash flow for doing nothing except owning the right stocks. Now, this is where one of the things I want to caution you is when it comes to the actual game of investing in stocks, stock picking, finding the right companies, there's a lot of risk involved with that because now all of your eggs are essentially in that one basket. Because if the company that you invested in goes down, well, you would lose money. If the company you invested in goes up, you make money. If you invest in Amazon and Amazon goes bankrupt, you lose everything. If Amazon takes over the world, you make a lot of money. But this is where if you are not interested in keeping up with companies, if you're not interested in researching companies, if you're not interested in doing that type of fundamental and financial analysis, you probably shouldn't be in the game of trying to pick stocks because there's a lot of work required in order to do that. If you don't know how or want to do that work and you're just picking stocks, then you're gambling. And well, when you gamble, you can make a lot of money, but you can lose that money just as quickly. The alternative would be to invest in a fund. This fund could be an ETF, an exchange-traded fund, or an index funds. These are funds where now you can get exposure to a group of companies. Now, one of these types of funds that you can invest in, one category, are dividend funds. Dividend funds are now funds that invest in companies paying out these dividends. And the reason why this can be beneficial is because now you can get cash flow without having to find the best cash flow producing company because now you can invest in these dividend producing funds. Now I'm going to go over a few examples and I got to give you that disclaimer here. I do not recommend what I do to anybody. I am not telling you what to invest in. Everything that I talk about in this video and all of my other videos are for educational purposes only. If you have questions, talk to a licensed advisor in your area and always do your own due diligence before you invest because investing has risks and you want to never, ever blindly trust a random guy on YouTube. Here are a few examples of dividend ETFs. Number one is SCHD, which at the time we recorded this video is paying just under a 4% dividend. Another one is VYM, which at the time of this recording this video is paying a dividend of just over 3%. And then you have VNQ, which is a REIT, Real Estate Investment Trust ETF, which is paying out yields of just over 4% a year in dividends. Now, what does this mean? ETFs trade just like stocks. You can buy and sell an ETF just like you would a stock, but the difference here is when you invest in a stock, you're investing in one company. When you invest in an ETF, now you could be investing in dozens, hundreds, or even thousands of companies. And so this now gives you the ability to lower your risk because if one of the companies in your ETF goes bankrupt, yeah, that might hurt your ETF, but it's going to be balanced out by all the other winners. Likewise, if you see a company in your ETF go really high, that will help your ETF, but some of those gains are going to be mitigated by some of the losers. So the advantage with an ETF is you no longer have to worry about trying to find and pick the best company. So you lower the risk, but you also lower some of the upside as well. However, if your goal is to build some steady cash flow and you don't want to go out and start investing in real estate, you feel like that's too much work, you don't want to have to build up all that capital to go out and invest in real estate, ETFs are a much more accessible way to do that because now you can start investing into funds that'll pay you with cash flow with as little as $100. I mean, you don't even need $100 to start doing this, but that's just a kind of a rough number to get started. So if you want to start generating cash flow, that's one way to do that. But here's the key. If you want to win as an ETF investor, as a passive investor, there's two things you got to do. Number one is you have to consistently keep investing your money. And the key here is you want that to be passive because now you want to invest regularly, whether it's every week, every 2 weeks, every month, regardless of what's happening in the markets, regardless of what's happening in the world. So if the markets are going down, you keep buying. If markets are going up, you keep buying. And this is where now you want to continually do this because the goal is to keep continually building those assets. You want to keep continually buying those assets that are paying you with cash flow because now every time you buy more of these assets, you're buying a little bit more cash flow. You're buying a machine that's going to pay you with a little bit more money. Every time you buy some, you're going to get a little bit more of cash flow. You buy some more, you get a little bit more cash flow. So you have to be consistent. The only time you would change this, the only time is if markets go down, you can potentially buy more, period. That's it. You're not going to sit here and try to time the market. If the markets go down, you say, oh, no, I'm scared. That's not what the purpose of this. The purpose of this, the way that you win is you keep doing it, whether the market's up or the market's down. And the second thing, if you want to accelerate your path to becoming wealthy, is that now when you get paid with that cash flow, you're going to take that cash flow that you get and throw it right back into the fund to buy more funds. So now every week you start buying some cash flow. You keep buying more assets that pay you with cash flow. Every week you buy more. Then 3 months later, and after 1 quarter, you're going to get a little check. Now, it might not be that big. It probably won't be that big, especially when you're just getting started. But instead of taking that check, this cash flow, this dividend that's now in your brokerage account, instead of taking the money out and spending it, you're going to put that money right back into it. That way you buy more. This way now you just keep consistently buying more of these asset producing cash flow, these ETFs, because now the goal is to do this not just for a month or 6 months or a year or 2 years or 5 years. If you do this for 10 years or 20 years or 30 years, now you're going to build a strong stream of cash flow that's passive on your end, and you won't even have to manage it because you're investing in the right funds, and you just need to start building that up. Start with $100 a week. Start with whatever you can. Maybe it's $10 a week. Maybe it's $50 a week. Start with whatever is accessible to you, and as you make more money, increase how much money you're investing. If you stick with this for 1 decade, you are going to surprise yourself at how much cash flow you can create, and you're going to build a whole new stream of income that's happening without you doing anything if you get started. But the key is for you to get started. The fourth place where you can invest your money if you really want to build wealth over the next 10 years are in growth funds. Let me give you a few examples and I'll explain how this works. Number 1 is QQQ, which gives you exposure to the NASDAQ. Number 2 is ARKK, ARKK, which gives you exposure to innovation. Number 3 is VUG, which gives you exposure to that traditional growth. Now, what does growth mean? Growth is generally that faster growing, more potential for appreciation in your investment, meaning you can see the value of your stock go up quickly. Now, that also comes with more risk. The thing that you have to understand about growth is that it's also tied to the strength of the economy and interest rates. When interest rates fall, more money generally enters the economic system, which creates more opportunity for growth companies, startup companies to raise money and grow quickly. You saw this happen in 2020 and 2021, especially when interest rates went to 0. Startup companies, tech companies, growth companies boomed. Why did they boom? Because they were able to get their hands on unlimited amounts of money for essentially dirt cheap, and they were able to grow very quickly. And so that's when you saw these types of growth funds particularly grow very quickly. Then came 2022. Things started to turn around very fast because in 2022, interest rates started to rise. When interest rates started to rise, it became much more difficult for these growth type of companies, these startup companies, to get their hands on more money, which meant they had to ease their foot off the gas pedal, and some of them went bankrupt, some of them had to do layoffs, some of them had to consolidate, and that was where it made it much more difficult for these growth companies to survive. Even in 2023, we're seeing a lot of growth companies struggle because of the higher interest rates. And so this is where you have to understand that growth companies are volatile. You're going to see periods of booms, periods of busts, but again, if you want to win in this game, you have to be consistent and understand that you're trying to invest for the long term, because now you believe in the long-term future of the economy. You believe in this long-term future of technology, and these types of growth funds can give you exposure to that, but it is riskier, which means you could also lose more money. So this is where now it becomes your job as a financially educated investor to understand how aggressive you want to be in your investments, meaning how much risk are you willing to take. The more risk you're willing to take, the more upside that you can see, but the more money you can also lose. And this is where you have to understand, if you want to make better investment decisions, it helps to understand how the economy works and how these economic decisions will affect different types of investments, like how interest rates will affect growth companies. Higher interest rates make it harder for growth companies to grow. Lower interest rates make it much easier for growth companies to grow. So it gives you kind of a different type of hedge in different pieces of the economy. But this is where now, if you think that we will see lower interest rates at some point in the future, that could create a big boom again for growth companies, which could create another opportunity for you. Number 5 is by strategic savings. And the reason why I'm bringing this up here is because right now we finally have the ability again to start earning some interest on our savings. And this is not by saving your money in a traditional savings account, but by saving your money in a high interest savings account. I was just checking my high interest savings account today. I have a handful of them, but one of them is paying me just over 4.8% interest. This is interest that I'm getting not for keeping my money tied up in a CDA. This is an FDIC insured bank. This is interest that I'm getting on my savings for doing nothing except keeping my savings there. Now again, 4.8%, yeah, it's a lot better than 0.1%. Maybe that's not going to be able to really outbeat inflation by huge numbers, but it's way better than what a lot of traditional banks are paying. And so now, if you are waiting for a good investment opportunity, like I have savings that are sitting there waiting for investment opportunities, that's why they're there. Well, instead of just sitting there doing nothing, at least you can earn some interest on your money. So if you have cash put aside, you're looking for good investment opportunities, you can't find them, maybe you think real estate prices are too high, stock prices are too high, that's okay. You don't got to jump in. But at least now you can earn something on your savings. And as interest rates go up, well, that also means that you can earn higher interest rates on some of your savings. So look into high interest savings accounts, but you have to understand two things. Number one, understand what the FDIC insurance limits are. Today, it's about $250,000 for individual accounts, $500,000 for joint accounts at one bank. So understand that if that bank were to go under, and you have more money saved in the bank than what the FDIC protection allows for, that means that you could potentially lose money, assuming the government doesn't bail out the bank like they did before or bail out depositors. So you need to understand that. And if you have a lot of money, you can also divide that up amongst different banks, different high interest savings account banks. And the second thing is you want to make sure you're using a reputable bank. The way you do this, just do a bunch of Google searches, learn about the bank, make sure they're FDIC insured, make sure they're a legitimate bank. There's a lot of different options out there. There's a lot of blogs out there that can help you out with this. There's a ton of resources. So just go check it out. Look into saving some of your money in a high interest savings account, because if you're not earning at least 3 or 3.5% on your savings right now, I mean, you're really just losing money by not moving some of your money into a high interest savings account. Number 6 is owning or investing in physical gold. Now, gold makes up about 2% of my total investment portfolio. I don't really like to consider it investing in gold. The way that I look at it is that gold is a hedge. It's a hedge against inflation. It's my doomsday protection, and it's an alternative way for me to save money. When I buy gold, I think of it like saving hard money. We talked about how real estate is a hard asset. Well, gold is a form of hard money. And so gold doesn't really produce any value the way real estate does. Real estate produces value because somebody can live in this real estate property, they can use it, they can pay rent, and if more demand goes to that particular area, that value of that property will become higher because people want to own that land, people want to be in that area. With gold, it's a little bit different. When you have gold, it just kind of sits there and it looks back at you. So gold doesn't really produce value the same way that real estate does, although there are some applications to physical gold. It's not the same as physical real estate. However, the value with gold is that you have a limited supply of gold, and it takes time, effort, and labor to mine gold, and it's a physical, tangible asset. Those are the values that physical gold has. And so now when I own gold, my theory is that if I were to buy $10,000 worth of gold today, and I had $10,000 worth of physical cash, and then I buried both of these things in my backyard today, and then 10 years from now, I went and dug them up, my theory is that the physical gold would be able to have more buying power 10 years from now than that $10,000 worth of cash. So that's why I own a little bit of physical gold. I don't really sit here and try to track the prices of physical gold. I just buy a little bit of gold every month. It's a passive system for me. And so it's not a huge piece of my portfolio. I understand it's not really a traditional investment. It doesn't produce me any cash flow, but it's a little piece of my portfolio as my protection against worst case scenario situations. Number 7 and 8 are my speculative investments. So about 18% of my portfolio is what I call speculative investments, and this is divided up between startups and cryptocurrencies. And when I say speculative, I mean these are things that could grow a lot and could also go to zero. When I invest in startups, this is a risky investment for me. My startup investments, I know most of them will go to zero. Statistically, 9 out of 10 startups will fail. But for me, I like investing in startups. That's fun. I like working with entrepreneurs. I like investing in entrepreneurs. I like providing the guidance with the entrepreneurs. And I'm very fortunate that I'm in a position where I can also help these entrepreneurs, not just financially, but through guidance and even through exposure. So I like investing in startups because of that. For me, it's fun, but I'm trying to get a return on my money. That's why I invest in startups. However, many startups will fail. That's the name of the game. So now, if you want to invest in startups, understand that number 1, it's risky. Number 2, that you're probably going to lose money. And number 3, the goal is that some investments will succeed and that those ones that succeed will make up for the losers. That's how it works when you invest in startups. Now, how do you go out and invest in startups? Well, nowadays there are a few platforms on the internet which will allow you to invest in companies looking to raise money. This is called crowdfunded deals. Crowdfunding is now where a startup is trying to raise money for their company, and in exchange for them raising money, they're essentially giving up some of their equity. They're giving up a piece of ownership in the company, and there are sites, crowdfunding sites on the internet, which allow and broker these deals that way now you can go out and invest as little as like $100 nowadays. You can invest as little as $100 into a startup, and you'll own a small piece of the company. If this company gets acquired later on for a big price, or they go public, you can get a big payday. If this company goes bankrupt, or they never get acquired, or they never go public, you might never see that money again. So you have to understand that going in. Is it risky? Yeah. Is it fun? Well, it depends if that's something that you're interested in. Number 8, the 8th place where you can consider investing your money, which is another piece of my speculative side, is cryptocurrency. Now, the reason why I like cryptocurrency and that I invest in cryptocurrency isn't because I think it's the next get-rich-quick scheme. Is because I see the value of the blockchain and I see the value of having this type of cryptocurrency. How do I know? Because I have contractors that work for me overseas. And before, I used to have a bank where I had to physically go into the bank to send wires internationally because some of these contractors lived in countries that did not accept PayPal and a lot of the other online places where I could send money. So I had to physically go to the bank to send one of my contractors money. And then I was traveling to California where I couldn't find a bank, and I had to pay my contractor, which became a huge headache. And that was when he asked me, can you pay me with cryptocurrency? I said, sure. I tried it. I went to my brokerage account and I sent him a little bit of cryptocurrency. He received it in a few seconds instead of waiting hours, and it cost me a fraction of the price. We're talking about pennies in order to send this money to him. And that was when it clicked. It became a much easier way for me to send money from here to overseas. It's a much easier way to transport money, and it has a lot of implications. Now, that does not mean that cryptocurrency is going to make people rich overnight, although that's what a lot of people think it is. And it does not mean that you're going to see a whole bunch of coins with cats and dogs on them go to the moon, although that's what some people think. There's a lot of value in the blockchain. There's a lot of power in the blockchain, but it's going to take time. And there's a lot of hype and emotion in cryptocurrency that people have to really understand where the value is. So I invest in cryptocurrency. Again, it's a passive investment for me. I invest pretty much every single day in cryptocurrency. It happens automatically. And for me, I'm really not monitoring it that closely, but you know, if cryptocurrency prices go up, that will benefit me. If it went down to zero, it's a small piece of my portfolio, and it really wouldn't hurt me that bad either. So if you are investing in cryptocurrency, make sure you understand how it plays a part in your portfolio and also understand the risks with cryptocurrency. And the 9th investment that you need to make if you really want to become wealthy is investing in your own education. And this is the investment that will give you returns like no other, because when you invest in your own education, now not only will you have the ability to, number 1, earn more money, but then number 2, you will also know what to do with this money. And number 3, you'll know where to invest this money. Number 4, you'll learn how to get better returns on this money. The way you do that is by investing in your own education. Start by watching educational YouTube videos and podcasts, because that's the lowest barrier to entry. It costs you no money, and you can do this just with a small investment of your time. The second thing that you can do once you start learning is you see, what do you like? Maybe you realize, oh yeah, I like this real estate investing stuff. Then read some books on real estate investing. Maybe you say, you know what, I like the stock market investing stuff. Read some books on investing in stocks. Maybe you say, you know what, I want to build my own business. I want to be an entrepreneur. Great. Watch videos and then start reading books on how to be an entrepreneur. Read about some of the great entrepreneurs. See what they did, see how they did it, learn from their biographies. Once you start reading books, that's when you then need to go out and take action. Start doing things. Start investing. Start building your own business. Start doing something. You're not going to be perfect in the beginning. You're going to make mistakes. You're going to screw up. That's okay. That's a part of the process. The sooner you get started, the sooner you're going to screw up, and the sooner you can fix those screw-ups. Then once you start doing that, that's when you want to invest in your education again. Maybe you read more books, but then maybe you can start buying some classes. Now, there's online classes are going to cost you somewhere between $50 to $5,000 online to learn how to do something. Use now what you learn from these classes and apply it into your business. But now you got to be doing something. Don't just start buying a whole bunch of classes and do nothing with that education. Start doing something and then use the classes to amplify what you do. If you're building a business, maybe you can take classes on SEO. Maybe you can take classes on Facebook marketing. Maybe you can take classes on email marketing. Maybe you can take classes on how to build content on the internet. If you're investing in stocks or real estate, take classes on that. Once you start to get a little bit better, then you can start investing in things like coaching and consulting. Now, instead of paying $50,000 to $4,000 or $5,000, now you might be paying $5,000 to $50,000, maybe even $500,000, depending on where you grow. But now you can start to see that as you make more money, you want to keep investing in your education. You want to keep investing back into you. That way you can keep learning more skills and more pieces and more things. That way you can continue to grow and thrive in the business and the investments that you're creating. That way you can continue to build your financial wealth. That way you can take better care of yourself, your family, and your community. But what about the tax-deferred retirement accounts? Things like your 401k. If your company offers you a 401k, before you go out and you dump all your money into your 401k, I want you to pause for a second, because unfortunately, the vast majority of Americans who have a 401k know nothing about what they are invested in, the fees, or how they can grow their money the fastest. And if you stick with me here, you're not going to be one of those people. If you want to maximize the returns that you can get out of your 401k plan, there are 5.5 things that you need to pay attention to. Number 1 is you got to pay attention to the employer match. Number 2, you got to pay attention to the fees. Number 3 are the investment options you have. Number 4 are the taxes. Number 5 is what happens when you leave the company. And then the other half is 401k alternatives, which you definitely want to pay attention to. Now, what I do got to let you know again is that although I am a licensed attorney, I am not your attorney. And if you have specific questions, talk to a financial advisor, a licensed advisor in your area, because there can be a lot of nuances with your 401k plan. So talk to an advisor in your area if you have specific questions about your plan. The first thing that you want to pay attention to is the employer match. Does your employer give you a match with your 401k? Some employers might say that we're going to match your contribution 100% up to 2% of your income. Meaning, if you make $100,000 a year and you invest 2% of your income, which is $2,000, your employer will give you an additional $2,000 essentially for free into your 401k. Now, it's not technically free because you have to work to earn that money. It's a part of your compensation, but that's what a lot of people like to call it, free money. So let's just go with that term for this video, where you're getting this $2,000 essentially for free and it's being put into your 401k. This is where you want to first clarify what is the employer match and understand what you have to do in order to get that match. And if you're just starting off, start by matching that employer match. That way now you can get started as an investor. Now, personally, I don't invest in a 401k. I don't use tax-deferred retirement accounts. But before you go out and just start avoiding these because you think they're bad and evil, at least get started with something like a 401k. It's better to have a 401k than no investments at all. This is an easy and accessible way for anybody to get started with their investments. Once you get started, that's when you can start analyzing other investment options and decide in the future if this is the right investment for you. But if your employer is offering you a match, at least get started with that. And if you don't know what you want to do, or if you want to invest your money outside of a 401k, well, get that match, then start investing outside of a 401k. And now you can compare. Do you like the tax deferred accounts like your 401k and the options and the control that you get here? Or do you like the non-tax deferred options like investing your money yourself? And now when you do both of them, that's when you can make that decision. So if your employer is offering you a match, number 1, see what that match is. And then number 2, at least contribute up to that match. That way you can get that quote unquote free money from the employer. And then once you start getting that free money, start investing your money yourself. That way you can see if it is worthwhile for you to continue getting that employer match or not, based off of the controls and the limitations that come with your 401k. The second thing that you need to pay attention to when it comes to your 401k are the fees. And interestingly, about 70% of Americans who have a 401k have no idea of what their fees are. This is according to the Consumer Financial Protection Bureau. And we covered this statistic actually in market briefs, because a lot of people have a 401k, but most people who have a 401k have no idea that they have to pay fees to have the 401k. So if you didn't know you had to pay a fee on your 401k, sorry to be that bearer of bad news. Now, if you do want to stay up to date on what's happening in the economy, what's happening with the latest economic trends, with the housing market, the stock market, that way you're not blindsided by what's happening, you can join Market Briefs for free. It's a free daily newsletter where my team is breaking down what's happening in the economy and the stock market and the housing market and everything in between. You can read it in less than 5 minutes every morning, and it's free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description description below. What I want you to do right now is, if you have a 401k, open up your 401k plan and look for something called the expense ratio. This expense ratio is the fee that you are going to pay for keeping your money in particular funds. See, when you invest your money into a 401k, you're not investing in individual companies. You're generally investing into funds where now you have either a computer or a money manager managing these funds for you. Now, when these funds are managing your money, whether it's through a computer or a money manager, there's a fee that gets paid to that investment brokerage that is managing your money, the fund owner. And that fee is called the expense ratio. And so what you want to do now is see how much this fee is and see if this fee is worthwhile. Because now when you're paying these small fees, they're also compounding. You're working to compound your wealth, your investments, but your fees are also compounding as well. Which means if you pay a small 1% fee on your 401k, and you do this from when you start your investing career to when you retire, that small 1% fee can eat up about 25% of your total investment portfolio, which means a 1% fee can turn your $1 million investment nest egg down to $750,000. Yes, all from a just 1% fee, because your 1% fee is compounding year after year after year on every dollar of profits that you make. So you definitely want to pay attention to these expense ratios. And then if you're investing in funds that have high expense ratios, make sure that the returns that you're potentially getting justify the higher fees. This is where it's going to require that little bit of financial education as well, because you're going to have a few options of where you can invest your money. Some of these fees might be higher, some of them might be lower. And now you need to understand what is a good fund for you. There's a bunch of videos on the internet and articles that you can look into, which will help you understand that, but you need to understand how much that fee is actually going to cost you. There are calculators on the internet that you can also use, that you can plug your numbers in and see how much these fees will cost you depending on the types of returns that you get. This brings me to number 3. What are your investment options? Because every company now is going to have different investment options where you can invest your money, different types of funds, different brokerages, different companies that you can invest your money into. And this is where now the general rule of thumb is diversify. And what diversify means, you want to have money into different types of funds. Now, this concept of diversification really just depends on the person. What Warren Buffett says is that diversification is for people that don't know what they're doing. And what that means is, if you are just a passive investor and you don't really want to have to care about what's going on in the world, you just want to put your money to work and have it hopefully grow, then that's where diversification makes sense, because you're not keeping up with your investments. If you want to be more involved, then diversification can eat away at some of your returns. But this is where we're now understanding what are the options. What are the different types of funds? You can have value funds, you can have growth funds, you can have international funds. There's a lot of different types of things that you can invest in. You want to pay attention to the fees, but then also understand, what are you owning? This is what financial education is all about. And this could be an 8-hour-long video or lesson right now about how do you find the right types of funds? What are the different types of funds? But the main thing that you want to understand, that I want you to understand here, is a difference between an actively managed fund and a passively managed fund. This is going to determine what the fees are. So I mentioned just a minute ago that your funds can be managed either by a computer or by a person. When a fund is managed by a computer, that's called a passively managed fund. When it's managed by a person, that's called an actively managed fund. Now, when it's managed by a person and it's an actively managed fund, the fees are going to be higher. Those are generally going to be like the 0.5% to 2% fees. When it's managed by a computer, that's generally going to be the 0.5% and less in fees. Some of them are going to be even less than 0.1% in fees. Now, the reason or the selling pitch for an actively managed fund is that this person can outperform the markets, that they can outperform the computers. Now, what we've seen historically is that most of the time, they will not be able to outperform the general markets. Does that mean that 100% of the time they're going to lose? No. But generally, that's what we see happen. There's always going to be exceptions to the rule. And so now, when you are picking your funds, you got to know what it is that you're investing in. If you're investing in actively managed funds, you want to make sure that the returns, the potential returns that you're getting, will justify the higher fee. If it doesn't justify the higher fee, then it might be better for you to invest just in passive funds. Some of these passive funds will give you exposure to the general stock market or to big groups of companies like the S&P 500, which is the largest 500 companies in the stock market. And the way that these passively managed funds work is that you build an algorithm. These funds will create an algorithm that says that this fund invests in the largest 500 companies in the stock market. And if one of the companies is no longer on this list, where they're no longer one of the largest companies, the computer will automatically kick that company out and put a new company in. That's why the fees are significantly less, because you don't have to have the money managers sitting there actively monitoring the accounts, versus with an actively managed fund, you need the money managers that are sitting there actively managing the money, which is why the fees are higher, and which is why you need higher returns to justify the higher fees. The fourth thing that you need to understand is taxes, because when you invest in a 401k, you'll have the option to invest either in a Roth 401k or a traditional 401k. With a traditional 401k, you pay taxes on the back end, which means you make your money. If you make $100,000 a year, you make the $100,000, and then if you invest 2% of that, $2,000, that $2,000 goes into your 401k untaxed. So all $2,000 goes into your 401k that can be invested over the course of your career. And then if that $2,000 grows to say $200,000, you then pay taxes on that $200,000 on the back end at whatever tax rates are when you retire. The flip side is a Roth 401k, which is now if you make the $100,000, you're going to pay taxes on all of that $100,000, which means you might be left with 70 grand. Now out of that 70 grand, now you invest, say, $1,500 as opposed to $2,000, and now this $1,500 goes into your investment account, and now maybe it doesn't grow to $200,000 like before. It might only grow to $150,000, but you no longer have to pay taxes on the back end when you pull this money out. The questions that you want to ask yourself are, number one, what is your income going to look like when you retire? Because the big selling pitch that a lot of people have with this is when you're 65 or 70 years old and you're pulling money out of your 401k, you're not going to have an income. So the tax rates won't matter as much. So if you plan on not having an income, then yeah, maybe that will work for you. But for me, that doesn't make any sense. I'm working to own investments, own assets, own businesses that will continue to grow my income. That way when I get older, my income's going to be a lot higher, not lower than where it is right now. So to me, I don't like that. For me, a Roth would make more sense because of that. The second thing you want to understand is where are tax rates going? If you look at the macro economy, you look at the state of the United States government right now, the United States government is drowning in debt. We still have a large national deficit, and it doesn't look like our national debt is going away anytime soon. The way that the government pays off this debt is by taxes. They generate tax dollars from taxpayers. And so if our debt costs, our servicing costs are going up now because number one, we're growing our national debt, and number two, the interest rates on our national debt are also rising. That means the government is going to have to pay more and more money in interest each and every year. How are they going to generate more money in interest? Well, they're going to need more tax dollars, which means that there's a high chance, a high probability that taxes will at some point go up in the future. Will they for sure? I can't predict the future, but just based off of these numbers, it seems probable that taxes can go up. So now based off of that and based off of what we decided in the first point, what is your income going to be? You can now start to make decisions as to do you want to pay taxes in the end where we don't know what the tax bill is going to look like. We don't know what the tax rates are going to look like. We don't know what your income is going to look like. Or would you rather pay taxes today? For me, if I was investing in a 401k, a Roth would be my decision because that makes more sense for me. But you are not me. You have different goals than I do. You have different interests than I do. You have different hobbies than I do. You have a different projection on where the economy and your investment portfolio will be. So pick what's best for you. But those are the types of questions you need to ask when you're deciding between a Roth or a traditional 401k. And the fifth thing you need to think about when it comes to your 401k, which is very important, which is what happens if you leave the company. Because we talked about, number one, the employer match. Well, many times employers are going to put restrictions on that match, which means you have to keep working at the company for a certain number of years in order to actually keep that match. Because if the employer gives you this free money and then you leave 6 months later, many times the employer will say, oh, no, you don't get this money, you don't get the match unless you work with us for at least another 3 years or something like that. So you have to figure out what the vesting schedule is to see when you actually get to keep that match. And then you got to understand that if you leave the company, what happens to that 401k? Because if you just cash out of that 401k before you're old enough or eligible to pull that money out, you're going to pay a penalty. So what are the options? If you go to a new company that offers a 401k, you might have rollover options with the 401k where you can roll that 401k over. You might be able to convert the 401k into an IRA, or you might even just be able to leave the 401k as it is. But this is where you want to make sure you understand if you have a 401k at a company and you're leaving, you want to know, number one, what's going to happen to the employer match that you got. And number two, What can you do with the 401k that way you don't have to cash out of the 401k and pay a penalty? What can you do with that money? What are your options, whether it's rolling over to an IRA, rolling it over to your new 401k, or keeping the 401k there? That way you can protect the money that you have in this investment account that you work to build. And then we have point 5.5, which is what are the alternatives to a 401k and why am I personally not a fan of the 401k? Now, again, I don't recommend what I do to anybody. The reason why I am not a personal fan of the 401k is because you can get a lot of tax benefits outside of the 401k as well. The reason why people love the 401k primarily is because of the tax benefits and because of the employer match. The employer match is great because you're getting quote unquote free money, but again, you got to work to earn that money. But then you also get the tax benefits, which people love. Now, what's interesting is you can get a lot of tax benefits outside of the 401k as well. Like when I go out and invest in real estate, there's a lot of tax benefits that I get with real estate as well. Real estate offers a lot of tax benefits. I can tell you as an attorney that real estate has some of the biggest and best tax breaks that a tax code has to offer. What are these tax breaks? Well, number one, when you generate an income, you can take write-offs against that income. And what smart people are doing and what smart accountants are doing isn't asking what is a write-off. They're asking how can you make things a write-off? How can you make expenses that you have in your life, whether it's eating at restaurants, having a phone, having a vehicle, traveling, how can you make these things write-offs? Now, again, in order to be eligible for this, you want to make sure you're following the rules of the IRS. They have to be related to your business. They have to be ordinary and necessary for your business, which is why you don't want to play games with the IRS. They will throw you in jail and charge you huge fines. Get a good accountant to help you with this. But that's the first layer of tax breaks and write-offs that you get. The second thing is real estate gives you a deduction called depreciation, which means let's assume that you made $10,000 worth of profit this year. You have $10,000 in your bank account. You then get to tell the IRS, hey, I made $10,000 worth of profit, but I want to take a write-off because my property is 1 year older. Now, depending on how much your property is worth, you can potentially write off all $10,000 worth of profit, maybe a piece of that depending on how big the property is, not because you have to spend money on anything, but just because your property is 1 year older. This is called the depreciation deduction, which lowers your taxable income only because your property is older. And this still applies even if your property goes up in value. And then the third thing is the 1031 exchange. If you bought a property for, say, $100,000, and let's assume that it goes up in value to $500,000. It really appreciated in value because you bought it in a great area. If you sold that property, you'd have a lot of taxable income. You'd have $400,000 worth of profit and a big tax bill. But what the 1031 exchange says is that if you take all $500,000 and you go out and buy a new property, a bigger property that's going to pay you with more cash flow, you don't have to pay a penny in taxes today. You can keep flipping these real estate deals. You have to own it for at least a year, but you can keep flipping these real estate deals, deal after deal after deal, and never pay a penny in taxes, assuming you never actually sell and keep that profit in your pocket. Because now you keep flipping into bigger properties, which are paying you with bigger cash flow. So yeah, there are a lot of tax break opportunities out there outside of the 401k if you're willing to invest a little bit differently than what the majority of people consider an investment. Now, while I'm on the topic of real estate, let's talk about what's going on in the housing market right now. It looks like home prices are finally dropping. Let me read you the title of this article from Reuters. U.S. existing home sales edge up, but prices drop by the most since 2011. The article goes on to say that the median sales price was $396,100, which is a 3.1% decline from a year ago in 2022, and that is the largest annual drop in home prices since 2011, more than 10 years ago. And where did prices grow? They grew in the Northeast and the Midwest. Hello, Detroit. But they fell in the South and the West. Now, it's kind of interesting because they're saying the home sales are rising, but home prices are dropping. You're starting to see this big change in the housing market. And why that might be happening as well, because interest rates have risen so aggressively. The Federal Reserve Bank has been working to raise interest rates to bring inflation down. Mortgage rates went from 2.5% 18 months ago to now about 7% today in mid-2023, which means if you want to go out and buy a home, now you're going to be paying way more money in interest, even if you're borrowing the same amount of dollars. So it has become so much less affordable to buy a home, but there's still a lot of people out there that want to buy a home relative to the amount of homes out there. Why? Because the inventory of homes are still so low. We have a huge inventory crisis here in America where there's not enough homes being built and there's not enough homes for sale. Now, a big question a lot of people have here is, how do we fix this inventory crisis? Is it by cutting interest rates? If you cut interest rates, what's going to happen? More people are going to want to buy a home. Home prices are going to want to go up. But developers might be a little bit more incentivized to go out and build. The key here to fix the inventory problem is developers and builders have to be incentivized to go out and build a home. Because if I'm a developer and I want to build an apartment complex, I want to build a subdivision, I want to build some homes, what I need financial justification to go out and build a home. Because if I'm a developer, I might be looking for a minimum 20% return on my money and my efforts. Because if I'm going to spend, let's say, $100 million building a new neighborhood, I better be able to make at least $120 million on the $100 million I have to invest. Now I have to go out and take on a lot of debt. I have to go raise some money. I have to go spend my time building this. There's a lot of work required. So you have to have some sort of margin. But the problem is, when developers are worried about the future of home prices because they're seeing what's going on with interest rates, they're seeing the issues going on in the economy, a developer might say, oh, you know what? I thought I'd be able to sell these homes for $450,000, but because of what's happening, I'm worried that maybe I won't be able to sell it for $450,000. And if we have to sell the homes for $400,000, we're not going to make any money. And that could be a big problem because then developers are much less incentivized to go out and build homes, because if they're worried about their profits, if they're worried they're not going to be able to make any money, they're going to be much less likely to go out and actually want to build a home because there's a lot of risk on them. Not to mention the fact that today getting loans is also becoming much more difficult after what we saw happen with Silicon Valley Bank, Signature Bank, and all the other bank collapses. We're seeing credit start to tighten. And when you hear credit is tightening, that means it's becoming more restrictive for builders, investors, business owners to go out and borrow money. Even consumers, it's becoming harder for people to go out and borrow money, which means less money going out there for people like builders to actually build homes. So now builders have to be able to justify the return. They have to be able to justify going out and taking the risk. And then they have to work even harder to raise the money, which creates more of the inventory problem that we're seeing. The inventory problem means that you have a lot of people that want to buy homes. People still have extra money to buy homes. They're willing to overpay to buy homes, even though they're very expensive because they want to own a home. And that's okay today because we still don't have that type of inventory. Now, what could cause this to flip? If you started to see more of a drastic decline in home prices, like we're starting to see home prices start to fall, if that were to continue, and you start to see more negative equity, meaning people become underwater on their properties, that could really start to flip the housing market, because that could flip the supply side of homes. See, the price of homes, just like every other asset class, depends on supply and demand. When you have more buyers than sellers, more demand than supply, the price of homes are generally going to go up because buyers are going to bid against each other to buy the limited supply of homes. But if you have more supply than demand, meaning you have more sellers than buyers, now the sellers are competing against each other to sell their home. How do they compete against each other? By cutting the prices of their homes, by cutting the listing prices to make their home more attractive. So in order for this to flip, either we need demand to drastically fall or we need supply to rise. Now, demand has definitely fallen. We still have a lot of demand, but demand has definitely fallen over the last 12 to 18 months because of the higher interest rates. A lot of buyers are now on the sidelines saying, you know what, we're just going to sit this out and we're going to wait a little bit because mortgage rates have gone up so much and home prices have gone up so much. So it's so much more expensive to buy a home. So demand has cooled, but it's still higher than supply. But what could cause the supply to flip is now if you start to see more people become underwater because home prices start to go down, well, then that could now start to force people to sell, because now they say, oh, I'm seeing home prices drop. We need to sell this property while we can. We need to get this cash out while we can, or we're getting worried about our jobs. We need to sell. Or banks start forcing people to sell. If that were to happen, now you have supply start to go up because now you have more people selling. Banks starting to foreclose. Now sales start to go up. And if demand continues to go down, now you have a problem, because now you have more supply than demand. Well, it's a problem for home sellers, but it's a good thing for people who want to buy a home, because then you have more buying leverage as a buyer. Limited housing supply is also hindering rapid improvement. There were 1.08 million previously owned homes on the market last month, up slightly from the April numbers, but down 6.1% from a year ago. We have a limited housing supply, which is making this housing market so difficult and made it so difficult for home prices to go down. But we're also seeing less supply now than a year ago, meaning less and less people are selling their homes. Why are less and less people selling their homes? Well, either people are saying, oh, I'm not getting as much money for the home that I wanted, or people are saying, yeah, we were thinking about buying a home, but maybe we'll hold off a little while. We're not going to sell our home because, well, we're not really sure what's going on in the housing market. Now, the key factor that you want to pay attention to in the housing market right now is what the Federal Reserve Bank does, because the Federal Reserve Bank is controlling interest rates, not mortgage rates, but interest rates. And if they continue to stay aggressive on interest rates, that's going to continue to put higher pressure on mortgage rates, which will continue to make housing less and less affordable. And now take a look at this article from Fortune magazine talking about the Fed's opinion on the housing market. The title is, "The U.S. housing market is, quote, putting in a bottom." This is by the Federal Reserve Bank Chairman Jerome Powell. Now, what was interesting about this article is it kind of talked about Jerome Powell, who's a chairman of the Fed's opinion about the mortgage and the housing market over a little period of time. Let me show you. In June 2022, Jerome Powell said that the higher mortgage rates would help reset the housing market because the housing market needs to get back to a place where housing demand and housing supply are back together in an equal area. What does that mean? We had way too much demand, way little supply, which was causing home prices to skyrocket. This was about a year ago, June 2022, and that was why Jerome Powell was very aggressive. If you remember back in the summer of 2022, Jerome Powell was raising interest rates by 0.75% again and again and again, and that was to reset the housing market to bring supply and demand here. In September of 2022, what Jerome Powell said was that the housing market officially entered a difficult housing correction that would restore balance to the housing market. So what Jerome Powell said was essentially, hey, when demand started to fall because of the higher interest rates, we were in a housing market correction. Not a housing market crash, but a correction because demand started to fall. Remember, supply was still way down here, but demand started to fall, and this is what he called a housing market correction, even though we were still seeing home prices rise across the board. By the end of November 2022, Jerome Powell said that we had entered a housing bubble during the pandemic. Big surprise there. And the reason why was because mortgage rates were very low. People wanted to buy homes. They wanted to move out of cities and go into the suburbs. And so you had this housing bubble that was formed because home prices were going up at a very unstable rate and causing overheating in the housing market. So now Jerome Powell is trying to essentially correct and prick that bubble, because when you had those low mortgage rates and this high demand, I mean, it was really the perfect storm in the housing market. You had low mortgage rates. You had people that wanted to move out of the cities into the suburbs, and then you had a low inventory of homes available for sale. It created this perfect storm where everybody wanted to buy a home, but there weren't that many homes for sale. So now everybody can get this cheap debt and outbid each other, and that caused home prices to skyrocket at essentially some of the fastest rates that we've ever seen. And that's what Jerome Powell says created that pandemic housing market bubble that he's now working to prick. And the way that he's working to prick this housing bubble is by raising interest rates. And this is where he says that now we're finally starting to see a housing market bottom. Now, the interesting part is, what does a housing market bottom really mean? Does that mean that we're no longer going to see home prices go any lower? Or does that mean that we're going to see more stability in the housing market, meaning enough demand to meet supply? There's a lot of uncertainty here. There was a lot of articles that were actually talking about what does this bottom actually mean. But this is where, again, if you are monitoring the housing market, the factor that you want to pay attention to more than anything else is interest rates, because that is going to drive not just the housing market, but the general economy, because higher interest rates are, number one, going to make buying a home less affordable. Number two, higher interest rates are going to cool down the economy. That means less people with jobs, less people with growing incomes, less people with the ability to buy a home. And higher interest rates also means less credit entering our market, less lending in the market, which could also slow down the housing market. Now, higher interest rates take time to be felt. It takes somewhere between 12 to 18 months to feel the effects of higher interest rates. And so this is where now understand that the housing market is already a slow-moving asset class. It's not like the stock market where you can buy and sell a stock in the blink of an eye. It takes time to sell a home. So now to see the effects of the higher interest rates in the housing market, that's going to take even longer. So understand, higher interest rates cool down the housing market. We're starting to see home prices start to drop. If we continue to see interest rates go up, that's going to continue to put more downward pressure on the housing market. More downward pressure on the housing market means demand will continue to go down. This will continue to push home prices up less slowly until demand starts to meet supply. Now, again, this can happen either if demand falls far enough or supply also starts to rise. So we've been talking about the demand side, that demand is going to be affected by interest rates. Interest rates make housing less affordable. That pushes demand down. Higher interest rates make the economy slower. That will also push demand down. But then, if home prices begin to fall more, that can affect supply because that can force people to sell. Either they want to get out of their home while they can, or that can create more foreclosures. We're still not really seeing any foreclosures because, well, people generally have equity in their homes. So even if you get behind on their payments, if you lose your job, it's okay. You can cash out of the home and move out and have some money in your pocket. It doesn't make sense to go through a foreclosure. But if home equities start to go negative, because home prices begin to fall, and then the economy starts to slow, that means now you're going to have people who own homes that are underwater that might not be able to continue making their payments, which could create more foreclosures, which could force more supply, which could flip the dynamics in the housing market. But again, this is a slow process. In 2020 and 2021, it was like this. Demand was way up here, supply was way down here, home prices kept going up. In 2022, we came down to here. Demand fell a little bit. The Fed called this a housing market correction, but we still had way more demand than supply. 2023, demand has come up here and supply has really stayed way down here. In fact, supply has gone even lower. So we have demand coming closer to supply, but it's still not there. Now the question is, where are we going to be in 2024, 2025, 2026? And this is where you want to be paying attention to the trends, but also keeping your eye on where interest rates are going. If you have $10,000 or more in debt, before you go out and declare bankruptcy, try this first. Being in debt can feel like you're in a sinking ship because all of your energy is going into not sinking. And in that situation, there are three things that you need to do. Number one is you got to plug the hole. Number two is you got to get the water out of the ship. And number three is